Welcome to Talk Tickers. You're busy, we get it, but staying informed on key earnings calls shouldn't feel like homework.
Definitely not.
So today, we're diving into the latest call from a major environmental services company. We'll pull out the crucial bits you need.
Yeah, basically give you the rundown on their performance and what's coming down the pike.
Exactly. Think of it as your shortcut to getting up to speed. Let's jump in.
Okay, well, this company really knocked it out of the park in Q1 2025.
Knocked it out of the park. Sounds good.
Yeah, better than expected results pretty much across the board. A really strong start to the year.
Okay, strong start. Let's dig into some numbers then. Revenue growth.
Came in around 12.5%, which is, quite solid.
12.5%, yeah, that's significant growth. But what about profitability?
That's where it gets really interesting. Adjusted EBITDA margin expanded by 120 basis points.
Wow, 120 basis points.
Yeah, a record high for their first quarter. And what's important here is the quality of that margin expansion. It's not just like temporary stuff.
Yeah. Right, it suggests something more fundamental is changing.
Exactly. The underlying improvements point towards a sustainable edge they're building.
So making more money, keeping more of it. And it sounds like this isn't just a Q1 blip.
No, absolutely not. The positive momentum they saw in Q1 actually picked up speed going into April.
Really? It accelerated.
Yeah, and they fully expect that trend to, continue through the year. A big piece of this is their pricing power.
Pricing. How did that look?
First quarter pricing was 5.7%. That was actually better than they had planned.
5.7%. That's a decent hike they managed to get. How are they pulling that off?
Well, a couple of things. They're being really strategic about the business they take on focusing on profitable new volumes.
And shedding the less good stuff.
Exactly. Deliberately moving away from, let's say, less desirable revenue. That discipline is paying off.
Makes sense.
Plus, we saw that return to positive volume growth continue from late last year.
Even with, I heard there were some weather issues.
Yeah, they managed that despite weather challenges hitting several markets.
Interesting. So how did they overcome that weather drag?
Key investments in growth areas really helped, especially extended producer responsibility, EPR.
EPR, right. Remind us what that is quickly.
Sure. EPR basically makes the producers responsible for their products at the end of their life. So for this company, it's creating new contracted revenue streams, particularly in recycling.
Gotcha. So that EPR boost offset the weather weakness in things like roll-off dumpsters and special waste.
That's right, in certain regions. And beyond that, something else helping their costs is labor.
Oh, yeah. What's happening there?
Big improvements in turnover, over 200 basis points better than last year's Q1, and almost 800 basis points better than Q1 2023.
Wow, nearly 800 basis points difference from 2 years ago. That saves a lot on recruiting and training, right?
Huge impact on costs, yeah. A real bottom line helper.
And are they using their trucks and facilities more efficiently too?
That's another key piece, absolutely. They're really focused on optimizing asset utilization, and that's feeding straight into those strong margins.
Okay.
Oh, and they also renewed 2 big long-term collection contracts with the city of Toronto.
The Toronto contracts, important ones.
Very key for their Canadian operations. And the renewals came with material price increases, bringing them up to current market rates.
Nice wins for them. Now, there was also a huge strategic move, wasn't there? The sale of a business unit?
Yes, the Environmental Solutions business, ES. That sale closed on March 1st.
Okay.
And while they sold it, they did keep a small interest. So, potential upside there if ES does well in the future.
Right. And they got a big chunk of cash from that sale.
A very big chunk. $6 billion. And they've been putting that cash to work pretty strategically.
$6 billion. Okay. How do they deploy that capital?
Well, over $3.5 billion went straight to paying down debt. Really shored up the balance sheet.
Makes sense. Strengthens the company financially.
Definitely. And they also used over $2.5 billion to repurchase their own shares.
Buying back stock. Mostly from their sponsor group, I heard.
Primarily, yes. Which, helps boost earnings per share for remaining shareholders.
And all that debt repayment must have brought their leverage down significantly.
Absolutely. Net leverage at the end of Q1 was 3.1 times. That's the lowest it's ever been in the company's history.
Lowest ever. That's a strong position to be in. Did the rating agencies notice?
They did. Both S&P and Moody's upgraded their credit ratings. And the company's not stopping there. They're still aiming for a full investment grade rating.
So with that stronger balance sheet, what's the plan for using capital going forward? What are the priorities?
The main goal is maximizing return on invested capital, ROIC.
Okay.
So that means first, investing in organic growth. Things like building out their EPR capabilities further, and also renewable natural gas, RNG.
RNG, that's capturing landfill gas for energy.
Exactly,
Good
methane
thing.
capture and conversion. Second, they'll keep looking for accretive M&A deals that add to earnings.
Makes sense.
And third, opportunistic share buybacks, especially if they think the stock is undervalued.
And they've already been busy on the M&A front this year, haven't they?
They have spent $240 million year to date on 3 deals.
Okay.
Those deals are expected to bring in over $85 million in annualized revenue. And about a third of that was effective Jan 1st, so it's already baked into their current guidance.
And the pipeline for more deals.
Still looks really robust. They're expecting to meet or even beat the high end of their target, which was $700 to $900 million in M&A spend for the whole year.
What about external risks, like tariffs or just general economic uncertainty? Are they worried?
So far, they said they haven't seen any direct material impact from tariffs.
Okay.
And they seem pretty confident they can navigate, this elevated macro uncertainty. They believe they can pass through any inflationary hits, whether on CapEx or costs.
Good to hear. So looking ahead, what's the financial outlook, guidance?
They'll give a full year guidance update with their Q2 results.
Right.
But given this strong start, they kind of hinted there are multiple ways they could end up beating their current guidance for the year.
Suggesting some potential upside then. What about Q2 specifically?
For Q2, they're projecting consolidated revenue around $1.675 billion
Okay.
and adjusted EBITDA of roughly $505 million.
That $505 million EBITDA implies still very strong margins.
It does. That works out to about 30% adjusted EBITDA margins for Q2.
30%.
Yeah, and that's over 150 basis points of margin expansion year over year, pro forma for the ES sale.
Impressive year-over-year jump. And cash flow for Q2.
Adjusted free cash flow expected around $100 million. That includes some cash interest, base CapEx, and working capital movements.
Okay, so summing up their strategy going forward, it sounds like it's about growth, margins, and smart capital use.
Pretty much. Maintain that leading organic growth, push adjusted EBIT margins towards the mid-30s.
Mid-30s, ambitious.
Yeah, improve free cash flow conversion into the mid-40s range, execute on that M&A pipeline, keep leverage in check, and broaden capital allocation to include buybacks and maybe higher dividends down the line.
Okay, that gives us a great overview. Now, let's maybe dig a bit deeper into some of those areas. You mentioned that Q1 margin expansion was driven by several factors. Can we break that down?
Absolutely. It wasn't just one thing. Let's tick through them. Commodities actually helped a bit in Q1.
Oh, like recycled paper prices.
Yeah, things like that. Gave them about a 15 basis point tailwind year over year.
Oh.
Foreign exchange, FX, added another 10 basis points.
Right.
There was an extra operating day in the quarter compared to last year, which helped by about 25 basis points.
It's having an extra day of revenue, basically.
Exactly. Then M&A activity was accretive, adding profitable businesses that gave them a 20 basis point boost.
Okay.
And the divestitures themselves, including ES, were margin accretive too. That was a big one, around 60 basis points benefit.
So lots of positives there. Were there any negatives pulling the margin down?
Yes, a few offsets. They had some one-off royalty payments last year at 2 landfills that created a drag this year, about 50 basis points headwind.
Okay.
There were also some provision true-ups related to selling the ES business. That was another headwind, roughly 60 basis points.
Right, some accounting cleanup.
Kind of. And then the weather impact we talked about, mostly February, probably shaved off another 20 basis points or so.
So when you net all that out, the extra day, the M&A, divestitures versus the royalties, provisions, weather, what's the underlying story?
The underlying margin expansion, sort of the core improvement, was still over 100 basis points.
Still over a full percentage point. That's strong.
Very strong. And that was driven primarily by, number one, price increases outpacing cost, increases that positive price-cost spread.
I don't know.
Number two, there's contributions from EPR and RNG initiatives kicking in. And number three, just using their assets better, that improved utilization.
Got it. That clarifies the margin picture. Now, let's circle back to the cash from the ES sale. About $500 million left on the balance sheet.
Yeah, roughly $500 million still sitting there.
You mentioned M&A and buybacks are priorities. Why didn't they pay down even more debt initially?
Good question. They felt the remaining debt was mostly long-term, and frankly, the investment opportunities they see, particularly in M&A, look pretty attractive right now.
So better returns expected from acquisitions than just paying down more long-term debt.
That seems to be the calculation, yes. That robust M&A pipeline is a key focus for deploying that capital. They're looking for deals that really add value.
And buybacks. Still on the table.
Definitely. That remains part of the plan, especially, as they said, if they think the stock is undervalued.
Right.
And actually, they recently got some relief from regulators, the OCE and TSX, regarding share buybacks from insiders.
Yeah.
That gives them capacity to buy back an additional, I think, 21 million shares if they choose.
Extra flexibility there. Okay, let's talk volume again. Q1 was surprisingly strong despite the weather. Can you break down the U.S. versus Canada performance?
Sure. The weather really hit special waste and roll-off volumes hardest, and that was mostly a U.S. issue in Jan and Feb.
Okay.
So overall, the U.S. business saw volumes down maybe 1.5% to 2% for the quarter.
Right.
If you try to strip out the noise, weather was maybe a 70 basis point headwind. The one less day impact was maybe 60, 70 basis points. Softer special waste, another 40 BPs. If you adjust for those, U.S. volumes were actually closer to flat.
Basically flat underneath the noise. And Canada.
Canada held up much better against the weather. The big driver there, as we mentioned, was EPR.
Right, the producer responsibility programs.
Yeah, that contributed over 5.5% to Canadian volume growth. Plus, there was a one-time project at some Ontario transfer stations that added another 230 basis points.
Huge boosts from those specific factors.
Exactly. If you exclude those, underlying Canadian volumes were also relatively muted, maybe slightly positive, but close to flat like the U.S.
It really highlights how important those EPR contracts are becoming for predictable volume.
Totally. They see those growth opportunities from EPR and other investments as pretty macro-agnostic, contracted volumes.
Less tied to the economy. What about the parts that are more cyclical, like construction waste?
Their exposure there, construction roll-off and special waste, it's actually relatively small compared to the whole business.
Okay. Looking ahead for volume for the rest of the year.
They expect positive volume in Q2. Then maybe tapering off a bit in Q3, still positive, but less so. And then Q4, they're actually guiding to negative volume.
Negative in Q4, why is that?
Mostly just a really tough comparison. Q4 last year had unusually high volumes because of some storm cleanup activity, so hard to beat that number.
Got it, a base effect. Now, M&A strategy, you said tuck-ins are the focus. Can you expand on that? What exactly are they looking for?
Yeah, so tuck-ins means smaller acquisitions, usually within markets where they already operate.
Okay.
The main goal is to buy businesses whose waste volumes can be tucked in or directed into their existing post-collection network.
Their transfer stations, landfills, recycling centers.
Exactly, because those facilities have high fixed costs. So pushing more volume through them increases utilization and dramatically improves profitability.
Leverage the existing infrastructure.
That's the idea. They believe that yields the best return on invested capital, the best ROIC.
So not really looking to plant flags in brand new cities right now.
Not as a primary focus. They said they're exploring some opportunities in early stages, but the main thrust is definitely densifying their existing footprint through these tuck-ins.
Makes strategic sense. What about those internal self-help levers for margin improvement, that $150 million target by 2028? How's that going?
They said they're making progress across the board. Things like reducing employee turnover, which we discussed.
Like the 800 basis point improvement.
Yeah, optimizing their truck fleet, routes, maintenance, and also pushing through specific pricing initiatives.
Okay.
The benefit is expected to kind of build up gradually over the next few years, not all at once.
Ratably, as they say.
Right. But they have had some big pricing wins already, especially in their residential book. Those Toronto contract renewals are a prime example.
How big are those price increases?
Significant. They kick in mid-2026. But for instance, one contract goes from maybe $16, $17 million a year to $37 million.
Wow, more than double.
Yeah. Another goes from around $10, $11 million up to $17 million. So really material increases reflecting current market conditions.
That'll certainly help margins when those kick in. One thing that stood out was corporate expenses being up year over year. What's driving that?
Good catch. So for now, the company has kept some of the corporate overhead costs that used to support the ES business they sold.
Wow, okay.
But the deal is structured so that the now separate ES business will actually pay them for providing those corporate services going forward.
Like a service agreement.
Exactly. They expect ES to pay them somewhere between $12 and $15 million a year, which will offset those retained costs.
So that cost increase is temporary, or at least offset.
Right. And only 1 month of that offsetting payment was actually in the Q1 results, so we'll see more of that benefit in Q2 and beyond.
Got it. Let's quickly revisit EPR, the rollout in Canada. How much longer does that have?
They expect it to continue for probably another 1.5 to 2 years until it's fully deployed across all the provinces involved.
Still more growth to come there?
Potentially, yeah.
Yeah.
If they win bids on the remaining EPR opportunities, they see maybe another couple $100 million in growth capex needed over the next 2-3 years to build out the necessary infrastructure.
Okay. Now, on the renewable natural gas side, RNG, any policy changes they're watching closely?
They're monitoring everything, basically. Volume mandates, pricing mechanisms, and especially tax credits.
Tax credits are always key for renewables.
Absolutely. There's been some policy noise, but they said nothing so far has had a material impact on their plans or financials.
Okay.
They expect updates on potential tax credit changes probably around September. And their current guidance already factors in their latest view on RIN prices, those renewable identification numbers.
Good. They're factoring in what they know. Thinking about margins again, Q2 versus Q1, what drives the typical sequential change?
Well, first, you have to remember to look at the historical patterns on a post-ES sale basis now. The business mix is different.
Right. Adjust for the divestiture.
Yeah. Commodity prices are a factor. They helped year over year in Q1, but based on current prices, they might actually be a slight headwind sequentially from Q1 to Q2.
Okay.
Fuel prices always matter. M&A timing plays a role, but generally Q2 usually sees margins improve sequentially from Q1.
Why is that?
Mostly seasonality. You get higher volumes typically in Q2 as activity picks up and you're exiting the tougher, more expensive winter operating period.
Right. Less snow, better efficiency.
Exactly. So that Q2 margin guidance of around 30%, even with maybe a slight commodity headwind quarter over quarter, still represents that big 150 plus basis point jump year over year we talked about. And underlying, they think it's probably another 100 basis points of core expansion if you strip out the noise.
Still strong underlying improvement. What about their landfill gas projects? How are those progressing?
They have 4 operationals now and 15 more under development.
15 more coming.
Yeah. The operational ones are mostly tracking to plan. One newer one had some minor operational hiccups, but they said they're addressing those and it was already factored into guidance anyway.
Okay, no major issues.
Doesn't sound like it. And they expect all 15 of those projects currently being developed to come online over the next, say, 2 to 2.5 years.
Steady rollout planned. Any issues getting equipment, like with tariffs?
They said no current impediments related to tariffs on equipment for those projects.
Good. One hypothetical. What if we see a spike in inflation this summer? How might that affect them?
Interesting question. Some of their revenue, particularly on the municipal side, is tied to CPI. So if headline CPI goes up, their prices on that portion go up.
Automatically.
Often, yeah, based on the contract terms. But their main costs are things like labor and fuel transportation. So you could have a situation where CPI jumps, boosting some revenue, but maybe wage inflation stays a bit more muted than it was during the last big inflation wave.
So revenue could rise faster than costs in that scenario.
It's possible. Their main focus, they stressed, is managing their internal cost inflation and making sure they price to maintain their profit spreads regardless of what headline CPI does.
They can adjust prices quickly if their own costs go up.
They showed they could during the last inflationary period, implementing real-time adjustments. They said they'd do it again if needed. But yeah, a scenario where CPI-linked revenue rises faster than their actual cost base could actually be favorable for their margins.
Interesting dynamic. Back to M&A one last time.
Yeah.
That focus on tuck-ins, driving volume to existing assets, are there specific types of assets or businesses they're prioritizing for acquisition?
Yes, definitely. The absolute key priority is buying collection businesses, the companies that pick up the waste, whose volumes can then be directed or internalized into their own transfer stations, their own landfills, their own recycling facilities.
Be their own network.
Precisely. Because, again, those post-collection assets have high fixed costs. Filling them up is where they get the biggest bang for their buck, the highest ROIC. So collection businesses that help them do that are top of the list.
Makes perfect sense.
They're also still investing in RNG and EPR infrastructure and looking for good organic growth opportunities like new city contracts, but always with that discipline around pricing and returns. So expect a mix of deals, but with a heavy emphasis on those collection tuck-ins in both the US and Canada.
Okay. What about their GIP business? That used to be called Infrastructure and Power, right? How's that doing?
Yeah, GIP. They said the inflationary headwinds that really challenged that business a couple of years ago are largely behind them now.
Good.
The M&A pipeline for GIP has actually ramped up significantly, and the business is basically back on track with their original plans.
So performing better.
Seems like it. Base EBITDA for GIP this year is expected around $225 million. And with deals they've done or have pending, they think that could get closer to $300 million by the end of 2025.
Solid growth trajectory there.
And interestingly, because of that turnaround and maybe some interest sparked by the big ES sale, they mentioned they're exploring a potential partial monetization of GIP.
Selling a piece of it.
Possibly. They said they've had significant reverse interest people approaching them, but they're not looking to sell the whole thing, just maybe crystallize some value.
Okay, something to watch. Final question. With all the macro uncertainty, tariffs, etc., are they seeing any change in behavior from potential sellers in the M&A market? Are people getting nervous?
They said, actually, no. Behavior has largely remained consistent.
Really?
Yeah. Sometimes uncertainty can even shake loose more opportunities, right? But they haven't seen any material shift in seller behavior because of tariffs or the broader economy. The M&A pipeline is just progressing normally.
Okay. Stable M&A environment from their perspective. All right, let's shift gears. This is not financial advice.
Definitely not. Just some thinking out loud.
So based on everything we've heard, what's an outrageous but plausible trade idea?
Okay. Idea one. Given this laser focus on tuck-in acquisitions, specifically designed to feed their high fixed cost post-collection assets, and the fact that this seems to be driving real margin expansion, and they still have firepower from the ES sale,
Right.
consider going long the stock. The outrageous part is betting that the market is still underestimating just how much synergistic value they can unlock from this focused M&A strategy.
You think the earnings growth from these deals could surprise?
It's plausible. As they keep adding these pieces and optimizing the network flow, the compounding effect on earnings and ROIC over the next, say, 12, 18 months could be significantly better than what's currently baked into the price. It's a bet on disciplined execution meeting opportunity.
Interesting. Okay, what's idea two?
Idea 2 involves EPR and GIP. We heard EPR is still rolling out in Canada, providing contracted growth, and there's nascent interest in the U.S. Plus, they just hinted at potentially selling a stake in the recovering GIP business to unlock value.
Okay.
So the trade, a pairs trade, go long this company's stock.
Right.
And short a basket of more traditional waste management peers who maybe aren't as far along in EPR or don't have a similar, potentially undervalued asset like GIP that they can monetize.
So betting on their specific strategic advantages.
Exactly. It hinges on the market eventually recognizing the value embedded in their EPR position and that GIP asset, potentially leading to outperformance versus peers who lack those specific catalysts. Again, outrageous, but plausible if those catalysts play out.
Got it. Two interesting angles there. Definitely food for thought. And that wraps up our deep dive into this environmental services company's latest earnings call. We've hit the key results, the strategic moves like the ES sale and M&A focus, and their outlook.
Yeah, covered a lot of ground margins, volumes, capital allocation, EPR, GIP, hopefully giving you a clear picture.
We certainly hope this breakdown provides valuable context and insights. What aspects really stood out to you, that intense focus on M&A integration, the potential in EPR?
Or maybe how they plan to navigate potential inflation. Lots to consider.
Definitely. We'd love for you to mull that over. But remember, as always, this analysis is purely for informational purposes.
Absolutely not financial advice. Do your own research.